This is the Aftermarket Radio Network.
You might know that this number is above, this number is below, but what does it all mean? Are they interconnected? Is one more important than others? And a lot of times what we see is one or two of these KPIs are really kind of the core effects that, will translate into 5, 6, 10 different things not looking okay. Now, it's kind of, anytime that you're looking at, are you treating the cause or the symptom, and your financials are no different. So this week is not how to read a P&L. There is no right or wrong way. But this is how I read and analyze profit and loss statements. Before we get into that, I just want to stop and say thank you to you and the rest of the dedicated listeners. Just like I mentioned earlier, this week's episode was a request from one of our listeners, Bill. And if you want your question answered, please shoot me an email at podcast@paarmelis.com. Just like for Bill, there was some aspects of his question I'm not going to share on here that was private, and it was specifically related to him. But if you have a question, I try my best to answer as much as I possibly can your specific needs. And then a lot of this is going to help other shop owners out there. If you are wondering this, other people are as well. And lastly, we cannot forget our dedicated sponsors. Without NapaTracs, without Promotive, there would be no business by the numbers. So do me a favor, if you're looking for a new shop management software, give NapaTracs a call and check them out. And if you're looking to add another team member, give Promotive a call and they will help you find the next rock star for your team. A lot of you guys have, had good luck with NapaTracs, have good luck with Promotive, and I've heard from a number of you guys reaching out saying, hey, talk to Promotive, talk to NapaTracs, heard them on your episode. If you have had a great experience with them, please shoot me an email. I love to give shout outs. I love to give credit where credit's due. So shoot me an email at podcast@paarmelis.com. Be happy to pass that along to the folks at Napa and Promotive, but also share it on here for other shop owners to enjoy as well. So before we get into talking about profit and loss statements, we do have something a little bit more serious that we need to talk about. And unfortunately, some of you guys listening to this have been directly affected by the hurricane that did hit last week, a week and a half ago. Families, communities, shops, I've seen the destruction. It is incredibly, incredibly devastating, and I can't even fathom what you are going through. So while the IRS, or really any taxes, is probably the last thing on people's minds, the IRS has given some extensions to those states and counties affected by this. Whether it's pushing back filing dates, pushing back deadlines to pay taxes on there, the IRS has given you some relief. Most notably, and there's a number of smaller aspects of this, the biggest ones that they just announced, which is why I'm putting this on here, is that those affected by this hurricane will have their deadline pushed back to May 1st. So don't need to stress about April 15th. They give you an extra little over 2 weeks to get that in there. If you're one of our clients, we're going to take that in consideration. We'll remind you come tax time. Does that mean that you should delay? No. But if you are affected by this, it does give you a little bit extra time. Now, these sometimes and often do change, and unfortunately, as I'm recording this, I just got a notification that the hurricane in the Gulf right now, headed towards Florida, is a Category 5, so this definitely could change or be extended even more depending on what we see for the rest of the hurricane season. Now, if you have been affected, you have friends that are affected by this, please share. I'm going to put a link in here to the IRS's official guidance on this. And like I said, if you haven't been affected, but you know someone else that has, hey, might brighten up their day a little bit to say, you know what, you're going to still have to pay the government, but you're going to have a couple extra weeks, months, whatever it may be. So now back to our regularly scheduled program. I have the luxury and the privilege of working with hundreds of shops, what I consider the top shops around the country. Big, small, Lamborghinis, ambulance, you name it, of all different sizes, types, and everything else in between. And if you look at numbers enough, you can almost start to paint a picture of what that shop looks like. But how do I compare a $6 million a year tire shop to a $1 million a year Euro shop? What is applicable? What shouldn't jive? And what do all of these things mean? We are all self-employed to make money, right? Even if you say that you are not in this for the money, you probably are, right? I've heard a lot of people say this. Well, hon, I don't care about the money. I'm here to take care of my team. I'm here to give back to the community. I'm here to give back to whatever, right? Maybe you just enjoy this. No matter what it is, how are you going to take care of your community, take care of your team, or continue to do what you love without making money, right? We're in America. This is a capitalist society, and money makes the world go round, and your business is no different. Now, a large part of my team's job is to not only deliver financial statements, bookkeeping, taxes to our clients, but also help guide them on these numbers. What do these numbers mean? How can we change or improve them in key areas to ultimately drive profit? And I've talked about this in the past, and this is one of those things that I have to sometimes stop and think about because it is so ingrained in my mind. I've been doing this for, what is it? I had to look at my clock to see what year it was. 2024, I've been doing this for over 16 years, which is really, really weird to say. One of the good things about doing this for as long as I've seen a lot, but unfortunately, some of these aspects almost I do subconsciously. And when I had to go down through this exercise of, hey, how do I look at a profit loss statement? I really had to kind of think about what my process is. Because just like a lot of things that you do in your day-to-day life, sometimes it's a little bit hard to train someone else because you say, I don't know, I just do it. And you really have to think deeply about what you're actually doing. Now, luckily for you, I did do that and I wrote it down. And I'm going to do my best to give you an easy step-by-step guide for you to do this for your own business. Have your own way to look at profit and loss statements? Think you have a really good understanding of it? Awesome. I'm going to be the happiest person to hear that, but maybe you can learn a couple things. Don't know where to start, overwhelmed and thinking, hey, I really probably should understand. This is exactly for you. When I look at financial statements, and on my notes, I just put financial statements, but we do this a lot on tax as well. I rely heavily on what we call assumptions and test. Right? So I have certain assumptions, and then we test those assumptions to make sure that it makes sense. Is something wrong? Is there a variable that I overlooked, and everything else in between? Now, more specifically, usually a lot of this is tied directly to certain metrics, right? And usually we're measuring profit. So, hey, if I think that this company, based on historic trends, overhead rates, gross profit percentage, labor rate, etc., I think if this company sells X, their profit should be Y. Now, if we go and we see, yeah, they did in fact hit that sales target, but we did not hit that profit target, we are now going back to those assumptions and looking. Now, was this a one-time thing, right? Was there some aberration, a huge comeback, a major overhead expense that we weren't factoring in, that the overall assumptions are still correct, this is just an outlier, or is there something that I'm fundamentally missing about this business? And this is exactly where you should start for your own business, and I'm going to give you those assumptions. So the model that I generally like to compare, or how I look at these, is what I call the 50-30-20 model. Talked about before, we've touched on this, but we are going to go into this step by step and go down to the exact numbers and categories that you are probably seeing right now in your own financial statements. And the model is fairly simple. I should say extremely simple, right? It's 3 numbers. And within reason, this pretty much works for all shops out there. And that's really important for me because, like I said, we have shops all across the country, Alaska, Hawaii, everything else in between. And like I said, we have a lot of different flavors. I have flat rate shops. I have salary shops. I have really big shops. I have really small shops. I have cool shops. I have boring shops and everything else in between. But these numbers we have found to be more or less pretty consistent within reason. So Hunt, that's great. You have a 50-30-20 model, but like I said, we're listening to this episode because I don't understand numbers and you just gave me 3 random numbers. So what am I supposed to do with this? So what the 50-30-20 means is we're going to kind of start from the back. We are shooting for a 20% net income, meaning 20% of my sales are ultimately going to end up in profit. Profit to get in my pocket, distributions, reinvest, whatever it might be. Now, maybe you're shooting for 15, maybe you're shooting for 25%. There can all be a little bit different, and we'll talk about that a little bit later on. Now, if we're looking for a 20% net profit margin, how do we get about that? So we've already figured out that 20 means 20% profit. So the 50% is what we call gross profit, right? So we have sales come in, 50% of our sales we know are going to go to our technicians, our parts costs, service advisor, sublet, shop supplies. Yes, I did have service advisor in there. If your service advisor is down in the expense category, you can obviously see how some of these numbers are going to change slightly up or down depending on where it goes. But just follow me along for right now. We'll talk about those variables a little bit later. But if we are looking for 50% gross profit after we pay our direct expenses, that means that we're going to have 50% of our sales left over. And if we want ultimately 20% of our sales to turn into net profit, we know that the difference of that is 30%. So that means if my gross profit is 50% and I can keep my overhead less than 30% of my sales, I am guaranteed to make a 20% net income, right? That is not some wild claim. That is just basic math there. Now, like I said before, what if your goal is 30%? What if your goal is 10% for profit? These are all going to change, and it might have to do with your business. It might have to do with your business model, but ultimately, this business is yours to make it whatever it should be. Now, the reason why I like to say the 50-30-20 model is, like I said, it works for most all businesses out there. If you are shooting for a 30% net profit, I will be very, very honest with you. It's going to be hard. It's going to be very hard. I work with, like I said, what I feel are the top shops in the country. And realistically, if you're going to have a consistent 30% or better profit margin, you're in very, very, very rare air. I think on a consistent basis, less than 1% of my client base is hitting those kinds of numbers, which means it is possible, but it is not very common. Now, how do we measure this, right? All right, Hunt, I now have this 50-30-20 model here. How do I use this for my business? And so what we do is, like I said before, we're doing tests and assumptions. And I just gave you the assumption. So if you are looking at your profit and loss statement, you need to pick out those three numbers of your business. What is your gross profit percentage? What is your overhead as a percentage of sales? And what is your net income currently? Now, as we talked about, and we've talked about time and time again, if your financials are not set up correctly, if your profit and loss statement is not set up, sales, cost of goods sold for direct expenses of parts and labor, and then overhead for everything else, you're not going to be able to compare apples to apples. Right? This is one of the most important pieces of having strong, accurate, and well-prepared financial statements is that if you aren't setting this up as kind of industry norms here, it's going to be very hard for you to compare yourselves to other shops as they do. Now, let's assume that you do have those set up, right? And you're looking at your current gross profit right now. That's where we're going to start. So as the assumptions have told you, we should be shooting for a 50% gross profit margin. Now you're going to look at your gross profit margin and you're going to see, what is it? Is it 50? Is it 60? Is it 40? Is it 30? Right? So you're going to see, is this higher, lower, up, down, wherever it might be. Now, if I take a look at this and I say, all right, my profit margin is 40, or my gross profit margin is 40%, or my gross profit margin is 60%, what does that mean? Doesn't mean anything just yet. Now we got to look at our overhead, right? What is our overhead? Our target is 30%. What am I at? Higher, lower, everything else in between. And lastly, you are going to look at your net profit margin, right? 20% is what we're going for. Now, if you were going to go and look at your own numbers and you say, Hunt, my gross profit percentage is 50.3%, my overhead is 29.7%, leaving me with just over a 20% profit margin, then lucky news for you. You have the model. You're running it. Now, could you improve it? Sure. But you're probably right where you should be in the grand sense of things. Could it be a couple points higher there? Could it be a couple points higher here? Of course it could. It can always be better, but more or less you're running what we would say is a prototypical model of a shop. Now, what if it doesn't, right? And I know how you guys operate, and I know how I operate when I look at a set of financial statements. I don't generally go from the top to bottom because let's be real. It's going to completely change how, when, and probably what frequency I'm looking at a financial statement, depending on what that profit margin looks at the bottom line, right? If I start at the bottom line and I see, hey, I'm at a 27% net income percentage, does that mean I shouldn't look at my numbers at all? No, absolutely not. You should still be looking at it, but you're going to be looking at that from a completely different lens, right? You're going to be looking at it saying, hey, I'm at 20% profit. Where am I doing better than the average here? Is my overhead lower than the norm? Is my gross profit percentage higher than the norm? Or a combination of both? Whether you're higher or lower than these assumptions, there's always something to learn from it. Now, if you are sitting there and you have a 20% profit margin, you're probably pretty darn happy and you're probably feeling like the world's best shop owner, which I'll agree. You're probably up there. Now, if you're on the other side of this, right, if you're looking at this saying, Hunt, I'm not at 20%, maybe I'm not even at 10%, maybe I'm not even at any percent, and I have a little dash next to my profit, meaning I don't have a profit, I have a loss. What do I do from there? So honestly, this is a lot more useful and honestly a lot more important if you are not making money, because these are the people that need to change and you're often wondering where to start. So I'm going to kind of give you two different examples here, right? And I'm going to kind of do these in a little bit different order, and I think you'll follow along why. So let's say that I'm looking at my net profit percentage, and we're going to look at two businesses, both not making money, but for two different reasons. So if I look at my business and I am making a 0% profit margin, right? I am truly breaking even. I'm not leaving any money to the bottom line. And I look at my overhead, and my overhead is 30% of my sales. So if I look at my overhead and it is 30% of my sales, but I'm not making any profit, then I know by default that my gross profit percentage is also 30% as well. Remember, if we're not making any profit and our overhead is 30% of our sales, gross profit pays for overhead and profit. And if there's no profit left over, we know that our gross profit is identical to our overhead. So again, I'm comparing those models side by side, right? And so if I look at overhead, 30% of my sales, that matches up to the assumption. It does not mean that there is not anything that could be changed there. It does not mean that there's not anything that could be improved there, but I probably would not start there because that one is pretty darn close, or in this case, exactly what our assumption should be. Now, we know that profit is not where it wants to be, but profit is also not an input, right? That's an output. That's a symptom. And if you look at this, if we have three categories, it only leaves us with one area, which is gross profit. So if we are looking at our gross profit now and we notice that we are at 30% gross profit compared to the industry norm or target of 50%, I now know where I can start zeroing in. So the whole idea on financial statements is you talk about, right? We are starting with a very, very high level. We are not getting into nitty gritty. We are looking first and foremost to triage this. Hey, do we have a problem or not? Or you might not have a problem. If you're making a profit, then you really don't have a problem. Now, if we do, we need to figure out how to fix that problem. And we're going to start getting more and more granular till we actually get to the root cause of this. So if I'm in a situation where my gross profit is identical to my overhead, but my overhead is at a reasonable amount, then I know my gross profit percentages need to be improved. And if I'm looking at gross profit, there's a number of things that go in here, right? You know, shop supply percentage, sublet markup, tires, all kinds of different things. But we strip this business down to the core. You guys are really selling two things. You guys are selling parts and labor. So everyone out there has a different target. I don't care how you blend this stuff, but generally what we're looking for is around 50% gross profit on parts, 60% or better gross profit on labor, which as a blended average works in, and we hope to have, after paying Service Advisor, 50% of gross profit or better. Now, I have to have a quick aside here, right? I know a lot of you guys look at Service Advisor as an expense, not a cost of sale. So this is where some of those intricacies come in there that, hey, if your Service Advisor cost is down in overhead, maybe overhead is 35, but then gross profit has to be 55, right? It's the difference between the two has to be 20 or whatever your desired profit is. So if I know my gross profit is lower than, the desired level, I'm just going to look at parts and I'm going to look at labor. Again, I'm still looking at assumptions. I'm testing those. Hey, I know it should be around 50% for parts. Where's my parts gross profit? My parts gross profit is at 48.9. All right, so we're pretty darn close there. How are we 20 points off still? And if this is the case of your business, if your overhead is okay, you're not making any money, and you're making good money on parts markup, I will guarantee you that your labor gross profit is lower than it should be. So if you were looking at this business and you're saying, hey, the key to profitability is cutting expenses, I would wholeheartedly disagree. If you're looking at this business and you said, hey, the key to profitability is increasing my parts matrix, again, I would wholeheartedly disagree as well. If I'm looking at that business, the biggest disparity between our assumptions and actual results is our labor gross profit margin, and I would be diving into that. Now, how you improve these specific margins is a much more complicated topic that we're not even going to get into today, right? This is why there's coaching companies. This is why there's consultants. Productivity, markup, everything else in between drives it. But at least you now know where to go. Remember, financials show historical numbers. You cannot change financials. It's already done by the time we are looking at it. But what financial statements are supposed to tell you is not only how much you made or how much you lost, but ultimately which levers you need to pull to change and get different desired results. So in this case, we're looking at it and we said, hey, we're not making any profit. overhead is the same as gross profit. Where the heck do we even start? By going down these different tests, we've been able to analyze the weak point in our business is the labor. And now you have one or two KPIs that you can really look at. Because if your overhead is okay and your parts margin is okay, not that you can completely take your eyes off of the prize here, but you more or less know, hey, if I can improve the labor side of this, whether it's hours, whether it's markup, whether it's rate, everything else is already in line. So ultimately, things should work out. Now, is that always the case? No, right? This is where the test and assumption come in. Hey, now I'm at 65% gross profit on labor. I should be at a 20% net income. And if I'm not, again, I got to go figure out where that difference is. So that is, when someone's not making money, there's really two major situations. The first one is that you're not doing well enough on the front end, right? You're either not pricing the stuff correctly, you're not being productive enough, you're not doing enough sales. Now, the other situation on there is probably a little bit trickier, but probably more common than that one, right? If you're looking at your financials and you're at 30% gross profit, you probably pretty quickly were able to tell, hey, I think that is my glaring issue. Now, what if you're looking at this and you're saying, well, Hunt, my gross profit is pretty good, right? It's at 50%. So that target matches it, but I'm at 0% net profit. And then where do we go from there? And so what we look at in a situation like that is saying, hey, we have the same amount as gross profit as we do overhead, right? 50% of our sales are going to gross profit. The other 50% is going to overhead. And what a lot of people will start looking at and even reach out to me and say, hey, I need to cut expenses. Where should I start? And I wholeheartedly disagree with that. Really, what you see there is that is the overhead that you need to run your business. Yeah, I'm sure that there's things that you can cut, right? I'm sure that there is taco trucks on Friday. Sure, you could cut out direct mail advertising. You could do a number of things, but what is going to be the long-term effects of those, right? Do you think that you're going to lose an hour or more of production, cutting out some of those fringe benefits for your team? And do you think that you're going to shoot yourself in the foot with future car count if you stop your advertising? So in a case where I'm looking at this and comparing to the model, and instead of a 50-30-20, we're seeing a 50-50-0, I don't like to try and cut that overhead by cutting actual dollars and cents. What I want to do is I want to make that overhead relatively cheaper by driving my sales. What that looks like in actual dollars and cents is let's look at $1 million a year shop. So this shop is doing $1 million a year. $500,000 is your gross profit and $500,000 is your overhead. So if I'm looking at a shop like that, no, I am not going to try to take my overhead from $500,000 to $300,000. Instead, what I'm going to try to do is take my sales from $1 million and drive it to 1.5 million. It is almost always easier, and I will actually say it is always easier for a shop to do that than to cut out, what would that be? 40% of your overhead. If you look down there, right, there's just a lot of non-negotiable. Your utility cost is what it is, right? Your administrative payroll is what it is. Your office supplies, your travel expense, your education, your professional fees, your taxes, all of that is what it costs to do business, the way you want to do business, where you want to do business. Those two examples are what I would say the two extremes. And there is even more extremes than that because we haven't even talked about people that are actually negative, right? If you're, instead of doing 50-30-20, if you're like 50-70 -20, yeah, you're completely out of line. But what we end up probably seeing is a little bit of a mixture of both, right? You're at 45% gross profit, you're at 35% overhead, leaving you at 10% profit, and you're shooting for 20%. Now, if you're that business, you're probably going to take those two examples that I said before and combine them, right? You're going to go down through, you're going to compare this, and you're going to probably come to two conclusions, both of which are accurate. Hey, we're probably not doing good enough on the front end, right? We're not maximizing our profitability, so we need to get a couple points there. Now, a lot of times, if you're increasing your front end gross profit, you could be doing it by driving sales or being more productive. That alone might increase your sales enough to get the overhead in line, but maybe you also do need to boost the total production amount to get it, right? A little bit here, a little bit there, but there's always going to be intricacies. Like I said before, 50-30-20 is the standard model, right? It is not meant to be the end all be all. And, depending on what your desired result is, these are going to look all different. Now, if you are shooting for a 20% net income, there is a ton of different ways to do this, right? You could have 55% gross profit and 35% overhead, right? You could have 40% gross profit and 20% overhead. There is so many different things, and who am I to tell you how to do business? And what you will notice is depending on where you are, some of these are going to be a little bit different. One of those examples is, let's say that you are in a very expensive area, right? Like we see this in Seattle, California in general, but specifically Southern California. There's a number of different places where it's just freaking expensive to do business. You might not ever be able to get your overhead at 30% or less of your sales. So if you cannot get your overhead below 40% and you still want to make a 20% net income, you can, but you're not going to be able to do that on 50% gross profit. You're going to have to do it on 60% gross profit, right? So if you have above average operating expenses, then you're going to need to do above average gross profit. Now, if you have above average gross profit and are able to somehow have below average overhead, then you're going to end up with above average profit, which is what everyone is shooting for. Now, a couple other things on here that will change this, right? And there's an infinite number of variables, but I have to mention a couple ones that, maybe have applied to you. A lot of times, owner involvement is ignored when we're looking at this model, right? 50, 30, 20, like I said, is a good model for most people. Now, if I look at a business that's at 50, 35, 15, is that necessarily a bad business? No, not at all, right? These numbers are just numbers. They do not tell the full story. And what I mean by that is owner involvement is a big piece of this, right? If I have an owner that does not have to go into the shop, maybe doesn't even live in the same state, we generally do not see a 20% net income. Because if you have enough people and enough personnel there to essentially work yourself out of a job, you're generally paying a little bit above average on some payroll costs, and we will see a little bit above average overhead or a little bit below average gross profit with having managers or regional managers involved. But if I'm looking at a business that's making a 20% net income, but my client is working there 2,000 hours a year, is that really a better business than my client that makes a 15% net income, but hasn't set a foot in that shop in 6 months? No, right? Keep in mind, these are just numbers. Another thing on there is depending on what you do, a 20% profit margin might not actually be possible. And I know that we don't do a ton of collision shops, and the average person listening to this is probably a repair shop, but collision shops on average generally do about twice as much in sales as a comparative repair shop to get the same amount of net profit. And what I mean by that is this. So if I have a repair shop that's making $200,000 of net profit on $1 million of sales, I would probably expect a collision shop to be at around $2 million to make that same $200,000 in net profit. The reason is a lot of times your margin on parts and even on labor to a large extent just aren't as high as what some of the repair guys can get. And so having a 50% or better gross profit on a collision shop is not as common as it is in the repair side. Now, I don't agree with it. I don't think that it is merit based on it. I'm just being honest here. Generally, a collision shop is going to need double the sales to drive the same amount of dollars. Now, if you do the math in your head, yeah, maybe that is not a 50, 30, 20 model, but a 40, 30, 10 model. Very similar. Tires are kind of similar as well, right? Let's say that you're a tire shop, meaning, 50% or more of your sales are coming from tires. 20% net income is going to be very hard for you. Now, why would that be? Now, think about if I'm a general repair shop. Half of my sales are coming from part sales, and half of those sales, if they're parts, I'm hopefully going to be selling at a 50% gross profit margin. Now, in the case of a tire shop, 50% of your sales are coming from tires. I'm not sure what you're making on tires, but I will guarantee you that you are not making 50% on the tires alone. Yeah, you add in road service, you add in, mounting, balancing, stuff like that. Don't get me wrong, it's a good business and you can make it work, but these are just different models that don't necessarily fit the mold. And somewhere in between, hey, maybe you do some collision work, maybe you do some tire work. This is where you will kind of see your own numbers are not always going to fit the mold exactly. At the end of the day, this model is not rigid and should never be taken literally by any stretch of the imagination. If you want a 20% net income, it's fairly simple. Your gross profit has to be 20% higher than your overhead. If your overhead is 50%, you can still make 20%, but you're going to have to get your gross profit up to 70%. On the flip side, Profit is easy if you ignore inputs like your time, stress, and employee culture. You might find that you can operate a 20 to 25% net income, but maybe a 15 to 20% net gives you more manageable and enjoyable business. The beauty of this is your business. You can make it whatever you want. Your name is on the building. Please share with friends. If you have any questions, comments, ideas for a future episode, please shoot me an email at podcast@paarmelis.com. Thanks again for Bill for getting me this awesome idea for an episode. I hope that you enjoyed it. And just want to say thanks again for listening on the Aftermarket Radio Network. You can find all shows like this and many others on the aftermarketradionetwork.com and on your favorite podcast listening app. So thanks again for joining me on Business by the Numbers. Stay safe out there, and I will talk to you all next week.